Let's continue with determining the turning points within the trend. So we've already defined its major support and major resistance and determining what a trend is and when the trend has changed. So let's talk about support and resistance and then the trend and these reference points, how to take advantage of them. So first, as always, we have to define what it is that we're looking for and what and why. So as prices are trending, and we see that they are, right, we've defined our major support points as the point where prices have made a higher high. In other words, they've taken out the prior high here. Once they've taken out the higher high, we've defined that as minor support. So as we look for prices to pull back within strong uptrends, they should hold at an area that we define as minor support. And then we're going to measure exactly where it does pull back to, how far. And I was already mentioned, if it pulls all the way back to major support, that's putting the trend in question. So that's how we're going to monitor retracements from these two reference points as prices begin to pull back. So again, minor support, major support once it takes it out, and we just continue as explained in the trend. Major support and resistance, we determine that on the third retest. And in other words, we defined a trading range at that point after the third retest. Within a downtrend, lower highs, lower lows. Every time it makes a lower low, we mark off major resistance. And what that low here that was taken out, that becomes our minor resistance point, and we just repeat the same process. Our methods are consistent, and we just repeat them, and that is what stops confusion in technical analysis. When you have clearly defined concepts, you just repeat them in multiple time frames. A resistance, once broken, becomes support, and I like to exchange support as being a reference point of demand. So there was supply there, and once it was overcome, and there had to be supply because if it pulled back from there and then it was overcome, that there was a supply point. But in an uptrend, prior highs are supposed to be overcome. However, once it is, we reference that as being a minor support point, and we look for demand to pick up there. Support, once broken, becomes resistance, or that demand point becomes a reference point of supply. On this slide, we have prices moving up, and this is the process that we go through, part of our analysis. As prices push up here, what was resistance should become support. But you can see as prices pull back into this area, we then look for demand to pick up, buyers, and we look for price patterns that are in alignment with our bias. And once we see that begin to happen, and it's happening right there, happening right here, as buyers begin to pick up, it provides us with an entry point to get long within the trend. And then we repeat. As prices are moving up, what was resistance should become support. And here we have a little bit of a sloppier pattern, but as that then pulls back to this area here, right, we then start the process over again and look at individual candles that are forming. I don't want to get ahead of ourselves here, but I'll just mention, notice the gap down here and reversal. That's bullish price action in alignment with a support area. As prices continue to push up, we repeat minor support, pushing up, major support, and we just continue that process along with recognizing the swing highs and the swing lows and our trend analysis. And we have a downtrend. Okay, what was support becomes resistance. As prices push lower, we can see what was support should become resistance. Notice the topping tail bar. What was support becomes resistance, topping tail bar. And you can see here it did not drop to the downside, and I'm not going to show you perfect patterns every time. There are going to be situations where you're going to be sitting through some wiggles, but you're going to have the kind of information analysis necessary to hold on through those wiggles. So, minor price resistance, breakdown again. We just continue the process over and over and over again. It becomes like, somebody would say, like factory work. Once you have a process in place, you just continue to repeat it. And that's where you get consistency in your analysis and your swing trades, that you're just continuing to do the same thing over and over and over again. Creating new minor support and major support reference point as the trend continues. So what's happening here, right? First of all, let's just start from the beginning here. We haven't talked about volume yet, but I'll touch on it here. Notice the volume explosion right over here as it explodes out of that area and pushes up here. Now, we're going to talk about price voids in a moment, but that's exactly what happened here. As prices pushed up, there was no reference point of support. There's the minor support point, if it was to pull back, would be here. It never pulled back to that. So it's creating new support here. And notice here you've got a swing low. 3 higher low bars to the left and the right. So it's now creating a new support point. That's bullish. So when you have a move up and prices are pulling back and they begin to pivot and there's no support to the left, that is interpreted as being bullish and suggests that prices are going to go higher. Once they do push higher, now we have our minor support reference point. Look for prices to pull back to that area and look for buyers to show up again. And we see that here they're beginning to create new support points. Buyers lurking below. What does that mean? Notice that big volume spike here. What it means is that prices broke down under the most recent low and they recovered immediately. That tells you that there's strong demand. There are buyers under there looking to get in on pullbacks, and that is the kind of information that helps you recognize the fact that there's institutional buyers there and that prices should go higher. And within an uptrend, this resistance point should be overcome. That's one of the assumptions that we make about uptrends, is that prior highs will be overcome because of the trend, but we also look at the price action. And in this case, we know that buyers are lurking below here. That's bullish and supports a bias that prices can go higher. Same thing here. New major support is created here on that pullback and prices push up higher. And as they do, minor support pushes higher, minor support. As I've said numerous times, we just continue to repeat the process continuously. Master Trader key concepts: sideways consolidations above minor support are creating support. It's very bullish. So, and it says the essence of a breakout and strength as prices are moving up and they create, I've said, this price void. In this case here, we've got this strong move up. We've got this little shelf right there, and prices pull back into it and create this support point and then move higher. RBI, you remember our acronyms, red bar being ignored, which means that there was this red bar, in this case a rather large one, and prices begin to go sideways again. What you want to take away from that is that candlesticks, even the foundational information of a big wide range bar or a bullish, or that's in this case a bearish engulfing bar, a large bar that suggests that prices should go down. You have to discount them a little bit within an uptrend, not ignore, but to say that this is an uptrend and that bar, if demand is as strong as we believe it to be because of the trend, it'll be ignored. And we see the same thing happen here. So that was the confirmation of that bullish trend. And notice the breakout here. the wide range bar pushing up, and RBIs, bottoming tails, the sideways consolidation here. All of this is bullish price action. Now, as prices pushed up, we then have a reference point of major support, 3 higher low bars to the left and the right. It made a new high, and then it broke it. The trend is broken at that point. And this suggests that prices would start going down. So we begin to follow that, and here we see that stage 3, distribution happening here, and it suggests that prices are going to move down at that point. And we just follow, and if they do, now we start looking for short setups. As I've mentioned, the goal here in educating is to teach you why things happen and understanding why we look at these concepts as we do. So we want you to understand how prices move. And prices move between these areas we call support and resistance. That's where buyers are stepping up at support. There's going to be sellers at resistance, and we have to put that within the context of a trend. So we continually assess these areas. We update that information. So as a trend continues, we get higher highs, we get higher lows. We're marking off our major support. If it's in a downtrend, we're marking off our major resistance. And we then continue to follow the trend. And if the trend is violated. Now, there are times where prices trend rapidly, or it could be a gap. It's the same effect where you get a very rapid price movement, or there could be a gap. This is what we call a void. A void means that there's no reference point to the left. And to visualize that in the example of a gap scenario, it's very easy because there's a void. There's nothing there. Price is gapped above resistance or gapped below support. So there's nothing there to trade against, so to speak. There are buyers at support. They bid there. They look to get long in an uptrend at minor support. If it violates minor support, there are subjective reference points that could be based on a moving average or a Fibonacci retracement or any of these things that could possibly be used. But as prices retrace further to that major support area, that's going to be your next reference point where buyers are going to show up. Now, in the idea of a price void, if there's nothing there, what are those buyers going to use as a reference point to buy? There's nothing there. So they're either going to create new support, which we've talked about, or they're going to wait for the gap to get filled. Or for our perspective, if it's in an uptrend and it gaps up and there's a void, once it forms a new pivot low, we look for a retest to buy against, because now we've got what I'll call a legitimate reference point of support that's been created by buyers. And they only stepped up there because they believe that at that point it's cheap. Prices are cheap. They've created this new support point, and we can now trade against that with the appropriate price patterns that happen. So here's the idea of the void. Fast price movement. As I said, rapid price movement where you could have multiple bars where the opens and closes are together and it moves very rapidly to the upside, sometimes vertically. Or it could be a gap. Prices were trading here and now they opened up here and there's a void. The other part of the void happens through time. So a rapid price movement creates the void, but at that point, time increases it. So from a long perspective, let's assume that this was a gap and now there's a void. We don't just want to arbitrarily buy because of that. And that's why I said if you get a pivot, right, where prices begin to pivot here, right, 3 to the left, 3 to the right, and then retest that area, and with the appropriate pattern, we can trade against this area here, looking for prices to go higher. Now, what if prices continue to go sideways and they move away from this rapid price movement and there's nothing here to trade against? Well, this big move here, which was an indication of strength, is what I'll call the weakest link. There's nothing here. Now, as time goes by after a strong move, what are they supposed to do? They're supposed to go up. Right? So a consolidation after a strong move creates a base. And that base is supposed to end with prices breaking out to the upside. Whereas if they do not, and they break to the downside, that opens up the door to a continuation move all the way back down because there's nothing to the left to trade against. Just imagine as if you bought here, or maybe if this was this rapid type of move, you bought on the way up. And now as it's going sideways, your assumption is that it's going to go higher. And that would be the appropriate assumption because of the prior strength. But if you noticed every time it got up here, it came right back down again, over a period of time, you'd begin to lose confidence. And once it was to break here, what would you do? You'd exit your position or part of the position. And as it's continued to go down, those that bought on the way up, more of them would begin to sell, and prices would, because of the void, have the potential to go all the way back down. So voids are very powerful concepts. Another type of a void is a new 52-week high. So there's no overhead resistance, and that's why hedge funds, mutual funds, investors look for stocks making new 52-week highs. There is no overhead resistance. However, it depends on how they got up there. So the ideal scenario would be one in which prices went sideways, right, after a move, and then we were buying breakouts to new 52-week highs, and now we have a very strong reference point of support underneath. So voids are powerful concepts. It's one of the concepts that we're going to put together with our trends. Now here is a void that's created through rapid price movement to the downside and then price movement over time where prices went sideways and then they pushed up here into this immediate overhead resistance area. Now, one of the things that we look at is the fact that if this was going sideways here and came up and then came all the way back down again, that in of itself is bearish because, well, it was trending down and buyers stepped up and it came all the way back in, which would suggest prices would move down. Now we get a gap up and this bullish price action that's occurring here. And we have this void up above. This type of bullish price action is one in which we're going to be very interested in buying. And notice the bottoming tail bar here. And we're going to get into candles, but I'm going to start showing you more and more these individual candles and combination of candles that are going to give us buying opportunities. And because of the void, this is why prices moved so rapidly. Well, let's just say there's two reasons why they move rapidly here. First, this bearish scenario that's set up didn't follow through. So those that may have shorted here, they're in trouble at this point. Short covering creates demand and buying. Those that would want to get long, of course, creates demand and buying. And now there's a price void, and that is a major reason why prices moved as rapidly as they did. When we get into multiple time frames, one of the questions that you're going to want to look at on your own would be, as you see a pattern like this, is to question why it happened. And that's, was there something to the left here? Was it an area of support in a higher time frame? And you see, as we start putting together these concepts, extremely powerful and putting the odds in your favor. Another void, a sharp move up, more of a trending move up, I should really say. Here, prices broke out. This was a sharp move up. Notice the bottoming tail, big reversal here, and the next little breakout. And as prices were moving up, of course that suggested it continued to go up. And then this movement over time, and notice that big wide range candle there, this movement over time should have resulted in a move higher because it was preceded by a strong move higher. Now when it breaks to the downside, support becomes resistance. You've got a nice topping tail right there. That's a great sell setup. With a void below, it should continue to go lower. Remember, when we look at a price pattern, it's a reflection of what others are thinking. What do they believe? What are they experiencing? So here, where longs were buying, they're assuming prices would continue to go up. One of the reasons why you got this wide range bar, right? And none of this is to suggest they were wrong. It's to recognize that we eventually found out that they were wrong. So let's take advantage of that. Notice the bottoming tail here. Buyers stepped up again on the retest. And we got some sloppy bottoming tail type of action here. But eventually they lost confidence and prices broke down. We look for a price pattern to sell short. We notice, well, not notice, I can recognize it right away that there's a price void because of what I've explained to you already, and that provides us with a great opportunity to sell short. Here's a really sharp move to the upside as prices were trending higher. Let's point out a few concepts here, like the red bar ignored, the wide range bar starting the move here, this pullback, this nice little bottoming tail bar, and notice how the ranges are about relatively the same. Now they accelerate higher, and now we've got a stall in the momentum here. But if you're thinking about shorting something like this, don't do it. Strong stocks that are perceived to be overbought can become more overbought. We don't do that as swing traders. Right? What we do is we wait and see if it'll go sideways. Will it form a retest pattern here? And when we have that, we can swing short that type of a scenario. Don't trade against the trend just because it looks like it's gone too far. They can go further than you can imagine. I've seen it happen over all the years I've been doing this, that trends do go further than you would believe is logical. So we don't do that. We wait for retest patterns in a situation like this. In addition, this kind of a pattern, when it forms, these are great scenarios for credit spreads, bear call credit spreads, where you've got a double top and an extended stock, and we look for these with relatively short time to expiration. And so this hasn't violated the trend, but we perceive it to be extended. We see a retest pattern, and credit spreads are a high probability income strategy in a situation like that. We haven't gotten into multiple time frames yet, but as I said before, I like to plant the seeds of thought where when we get to the concept that we will be talking about. So you cannot see the time frame here, and a lot of the examples I'm showing you don't show you the time frame yet because I'm showing you a concept. However, let's imagine for a moment that this is a monthly chart. If we were to move to the daily time frame, we just might see in a lower time frame a movement through time. So where this 3-bar reversal here occurred, let's just clear this up for a second. This 3-bar reversal, imagine that happening over 3 months, where this was going sideways on the daily chart, and we could be moving into that smaller time frame, taking an X-ray, and at that point having high probability patterns in that smaller time frame where this could actually pull back. So think about that. We're going to look at it when we get to the multiple time frame section. And as I said, we're planting the seeds here of thought to reinforce when we get it there. Here's a smaller time frame, and this could be exactly the type of price pattern that we would see on that smaller time frame, where prices were trending up. They made a new high and failed. They came back down, retesting, big wide range bar to the downside, sideways price movement, and now we're waiting for the break. And in addition, as mentioned already, credit spreads are an awesome scenario or strategy for generating income in a situation like this, where we would say prices they're not likely to go above this high here. And let's just imagine that we got a big red bar, and the more information that we can gather, right, a retest there and a red bar strongly suggests prices wouldn't get above here. So credit spreads are excellent income trading strategies when you combine them with the price patterns that we use. Different type of situation. Big gap lower creates a void. How are you going to handle this? Well, don't get so anxious because this is pretty bearish. Wait for the opportune moment. And those opportune moments, you look to the left to see what was support should become resistance. Now, we did get a pattern here, but it certainly could have moved up to that level before it turned. So when we recognize reference points, that is one part of our analysis. Then we look for the patterns that are in alignment with that bias. In this case, we get a reversal patterns up here into this area of resistance. Now, this low here created a support point, which potentially could make a buy setup. Even though this is very bearish, this move down, there was a bounce here, and here's a retest. For us to consider this on a short-term basis, prices would have to trade above this high. One of the things we'll talk about in money management is that is part of our method and strategies, that once we see a pattern, we always need confirmation of it prices trading above a prior bar's high in this case. And if we were thinking short, it's got to trade below a prior bar's low. Attributes of a strong uptrend. The gaps are left unfilled, which you can see here at the beginning. That is a strong indication of strength and strong demand. Gaps are left unfilled. I've already mentioned a few times, relatively equal size bars. Prices are moving up with certainty. Ranges begin to expand, but then notice how it tightened up again here in this area of support, that pivot low. So prices move sideways rather than retrace. That's bullish price action. They consolidate at resistance and absorb that supply. So what we're building here is different concepts that guide us as to who's in control. Is it buyers? Is it sellers? Who's taking control? Who's losing control? What is the trend? All of this comes together to formulate a bias that we're going to look at in multiple time frames that are going to put the odds overwhelmingly on our side. Let's continue.